For more on this, we start with Jessica Stone, who has been watching, and you've been running around the newsroom, and I know lots going on, so I'm throwing it to you.
So much, so many people, so much attention. People have been waiting and waiting and waiting on this, Phil. And of course, this whole process got the name Fed Watch, even among financial journalists. But of course, that's also been part of how the Fed manages stock market expectations. The key here is, from this decision, is that this is a small step with big implications. It means U.S. central bankers believe the U.S. economy is strong.
What happens in this building is watched the world over. It's the U.S. Federal Reserve. For 9 years now, finance ministers, stock markets, and anyone who uses a credit card have wondered when the U.S. Federal Reserve would raise interest rates. The long-awaited answer came on Wednesday when U.S. Fed Chair Janet Yellen announced a quarter-point increase.
It also recognizes the considerable progress that has been made toward restoring jobs, raising incomes, and easing the economic hardship of millions of Americans. And it reflects the committee's confidence that the economy will continue to strengthen.
During the past 7 years, interest rates have hovered near zero. Now that fewer Americans are out of work, the Fed is raising rates. The nation has come a long way from its peak unemployment rate of 9.8% in 2010. The Fed board now projects 5% unemployment is within reach. When considering a rate hike, the Fed also watches the inflation rate. The board wants to see it at 2% over the long term. But look at where it is now, closer to 0.5%. Nonetheless, Yellen says the Fed governors believe over time U.S. inflation will get to 2% and that there's actually significant risk in waiting too long to raise interest rates.
What we would like to avoid is a situation where we have waited so long that we're forced to tighten policy abruptly, which risks aborting what I would like to see as a very long-running and sustainable expansion.
An expansion, Yellen says, which will see interest rates gradually rise, but leaves room for the Federal Reserve to also change course, depending on what happens in the U.S. economy.
Now, of course, over the last 9 years of low interest rates, the Federal Reserve's balance sheet, or I should say the last 7 years of those low interest rates, the balance sheet has ballooned from less than $1 billion to more than $2 trillion. Yellen says the U.S. wants the Fed to hold a lot less cash over time, but that the governors also have to balance that goal with their need to use that cash to keep the U.S. economy moving, because, of course, that's the goal, Hill.
Ready for my first dumb question? So the Fed raises it 0.25%, and us media people, we get absolutely crazy over this.
Well, it's a big
well,
implication.
You're
right?
going to tell me why it's a big deal, but why does it matter for consumers, for just normal people?
You're right. There's not a huge impact for them. This isn't going to impact what they pay on mortgages or credit cards. Most of the credit cards aren't pegged to this. We did, though, see home equity lines of credit go up 0.25%. Wells Fargo raised their lending rates from 3.25 to 3.5%. People with money in their savings account, they'll see a little bit more interest on that money. But overall, this news is about sending a signal that the U.S. economy, Phil, is growing again. And we've said that time and time again.
Yeah. Now, there's also the flip side of it, because it's not just about America. What the Fed does impacts the rest of the world. A lot of people, from the IMF to different central bankers, have warned that an interest rate rise would negatively impact them. But we're not seeing that, at least not in the markets. What do we know so far?
Well, markets are happy. They got what they wanted. It was projected and it happened. But we are going to be watching the Brazilian economy, the Chinese economy. We could see some central bank moves in those countries because their currencies are pegged to the dollar. And a lot of companies in those countries do business and they take out loans in dollars. We already know the dollar has been strengthening, and it does make it more expensive for those companies to do business, more expensive for people in those countries to do the same. Again, we're looking at Brazil and India. China could have to buy its own currency, which is the opposite of what it wants to do in trying to keep its economy growing. Yellen, though, she's very well aware of the impact on other currencies that are pegged to the dollar, and she says the Fed will continue to monitor the impact of this decision on other countries and their monetary policy.
We are constantly monitoring foreign economic developments, including those in emerging markets. We understand that in the global economy, with integrated product and capital markets, that our fates are very much linked, and that the performance of the U.S. economy has important spillovers onto emerging markets and vice versa.
And of course, in the specific case of China, a stronger dollar could force China to intervene in its currency markets to keep the value that the PBOC has set. We do know that the Chinese economy is slowing down, and we also know that the Chinese central bank is flush with cash. It's been selling off millions of its foreign reserves, but it may have to switch to buying yuan, which then would take money out of the Chinese financial system, which takes more cash out of the economy at a very sensitive time, Phil.
All this is stressing me out, Jess. Okay, we're going to get reaction from China within the hour because markets there are going to open up. Thank you very much.